big hello and welcome to R J Sanderson TV, your monthly dose of everything tax, finance and economics. Dave Kennedy is my name and joined as always by Roy Sanderson. Roy, welcome. We've got another big show to discuss today, and off the top, a new governor of the Reserve Bank.
Yes, Dave, great to be here again. And yeah, lots happened in the last month. Very interesting.
Let's get straight into our news headlines as we always do. And I mentioned off the top there that we've got a new governor of the Reserve Bank, Michelle Bullock. She has presided over her first meeting of the Reserve Bank, and the outcome of that meeting was favourable for the punters. No change to interest rates, and that means that it has been a fourth straight month of unchanged cash rate at 4.1%, Roy.
Yes, and we predicted this last month, Dave, that we didn't think there'd be another increase for a little while. I know one of the major banks has suggested there will be at least one more increase. I'm maybe hedging my bets and suggesting there will be no further increases, so going out on a limb there.
The interesting part of this, as we said, it's the new governor, it's new management, new board of the Reserve Bank, and interestingly, the committee reiterated any adjustment will depend upon how the economy and prices evolved, but they also warned that potential monetary policy tightening might need to occur unless there is a change. And potentially part of the reason is because of this pesky inflation rate that still remains at relatively high levels. On this graph, it looks as if it's at a low level, Roy, and that's partly because of how high it has been over the last 12 months. But 5.2% is still outside the Reserve Bank's targets, or the Australian government's targets, of inflation between 3 and 4%.
And this is probably the most disappointing stat of the month, because we had hoped that inflation would continue to come down. And I think when they drilled down to the details, if I remember, it was transport costs and fuel that have gone through the roof that's caused inflation to go up. And that's going to be the determining factor if the Reserve Bank increase or stay where they are.
And that's also another drawback of the Reserve Bank system that people have been highlighting over the past few months, Roy, is that monetary policy is a blunt instrument in its nature. We've seen, as you mentioned, transport prices increase 7.4% versus 0.3% the previous month. So that is an extraordinary rise. And we've seen the overall indicator only rise by 0.3%. So obviously, potentially there's two ways of looking at it. You have monetary policy on the one hand that can either put interest rates up or down, or you have budgetary policy who can target transport prices, who can provide more tailored solutions to fix that problem in isolation. And we've seen that in the past. We've seen changes to excise tax on fuel. We've seen temporary relief from fuel prices as a budgetary policy that the government has used. So that is potentially one of the drawbacks of monetary policy. How that affects consumer confidence is interesting, Roy, because this one has gone up in recent months, but it is still in deeply pessimistic territory as the indicator suggests.
Yeah, interesting that it did go up a little bit. And when I saw this graph, I was pretty pleased. But as you pointed out, it's still 82 out of 100. It's pretty awful. So we're not feeling too confident, are we?
Remembering that those 78.5s that we saw in February and March was the first time we had back-to-back readings under 80 since the deep recession of the early 1990s. So that gives some perspective. I know I've mentioned that a few times on the show, but that gives some perspective to how low the number 80 is in terms of this indicator. We're used to seeing well into the positive, well over 100 consumer confidence. So we are still in deeply pessimistic territory. They did make mention of the fact that there are some faint glimmers of hope around family finances and the outlook for jobs, but how does that sort of correlate to the mood that you're hearing from other people, Roy, in the community around consumer confidence?
Yeah, I think the stat bears fruit to what I'm hearing from clients. So nobody's feeling fantastic about where they're at from a consumer perspective right at the moment. Refunds are lower. There's less money in the economy right at this moment. And I think the stat's spot on.
I think the interesting thing is, like, when you've got such high inflation and this is a period of time that I can't remember in the past a time of particularly high inflation, continually high inflation. It does become insidious. I think as a father, as a family person, you look down at the budget and you think, geez, the groceries are far more expensive than they used to be. And it's almost insidious in how it sneaks up on you. Suddenly you look back and you realise, geez, we haven't saved any money. In fact, we've spent more than we've earned for the last few months.
And there's been no wages growth over that time frame, which makes it worse.
And part of the reason there's no wage growth, we've got a sneak peek of that before, is because of how low unemployment is at the moment. It's at that 3.7%. It is still, it's still relatively low. So potentially there's not, a huge urging from businesses and employers to need to boost wages because there is no shortage there is no workforce that is seeking full-time work. The number of people in the participation rate is lowering.
Yeah, this is an interesting graph because I'm not quite sure what the right number is that the government should target. I will go out and say it's probably not much lower than 3.7 to 3.5, much lower than that. And you've got a lot of pressure on industries and occupations where we can't get labour. So, you don't really want that stat going too much lower than where it is right at the moment.
So the number of people seeking full-time work actually did increase, apologies for that, but the number of people seeking part-time work dropped. So we're sort of getting swings and roundabouts on that unemployment rate, which does rely on the participation rate and then also the number of people who do find meaningful employment. Business confidence is the next indicator that we're going to have a look at. And again, we have been in a pretty continued environment of no change now. 3 months of back-to-back readings of just one, which suggests, you mentioned the term hedging your bets. I think that's what the business community is doing at the moment, Roy. There's not really any meaningful changes to this indicator, which is suggesting let's wait, let's see how things resolve, and probably a good time to bring up what's happening in the news at the moment. We've seen, a war break out again, or some would say there's a continued war, but that's for other people to discuss. But there is obviously heightened tension in Israel and the Gaza region. So we saw how the Ukraine conflict actually impacted markets at the start of this year. This could really have some ripple-on effects into the business community and also, by extension, to consumers.
Oh, I think it will have. And the stats that we've just seen on the show are pre the Israel conflict. So I think that what's going to happen over the next coming month or months, because this is unlikely to be a short-term issue, will be a bit of a hit to consumer and business confidence, I'm sure of it.
Exports have increased, Roy, and it's the first time in the last 3 readings that exports have rebounded. And one of the reasons for this overall change in exports is that exports to China grew. So China being the country's largest trading partner, they grew 5.1% month on month, which is interesting because, there's, again, we talk about geopolitical tension. There has been enormous geopolitical tension between Australia and China, but the export market to China starting to bounce back, and maybe some small steps in the right direction after some meaningful conflict resolution from the government. Yeah,
some diplomacy issues certainly being sorted out, which is great to see. But interestingly, when that was a 12-month graph, and we're still 10% below what we were 12 months ago. So we have a fair way to go to recover to where we need to be.
Exports are an interesting thing, Roy, because I think they come back to some of the other topics that we've discussed on this show, things like productivity, imagination, and being able to, again, like we rely very heavily on our minerals and commodities market for export, and that's it's a big part of what China exports from us. But encouragingly, I heard today that that Australia has advanced its standing as a world leader in education, in tertiary education. We now have more international students than other countries around the world. That type of product is a more sophisticated product that is going to give us the economic complexity that we need to continue to advance our export market. And I think it's a real focus area for governments to continue to look at, as we've talked about in the past, because once we mine everything, what are we going to do? What are we going to export? And Roy, I know you're a big, you're a big believer in a super profits tax.
Yes.
But time's running out on that front. You know, we're going to mine everything eventually.
Eventually, we will have everything mined, and education is a fantastic resource if we are going to be exporting that. And opening up China's borders, I think, is fantastic.
Retail sales month on month did increase. It was a small increase of 0.2%, but it was still a smaller increase than the gain in July. So. This, again, is sort of, you can see how it's close to flatlining in most of the previous months. This sort of, again, illustrates that idea of hedging bets. People are not taking any chances at the moment. And it suggests that there's still restrained spending in these times of high interest rates.
And I know I've said this before on the show, but the refunds this year are less than last year because the low middle income tax offset doesn't exist this year. And last year it was $1,500. And if you looked at exactly 12 months ago, when people are getting their refunds and then spending it at retail, there's less money coming into the refunds, therefore there's less money available. So the difference between this time last year is, I think, partly to do with the fact that the government have sucked out these refunds and made them a lot lower.
The stock market over the last 3 months, Roy, where are we at on the ASX 200? We like to look at the difference between the stock market and properties as potential investment options. Where are we at?
So I wanted to do the last 3 months because I've been saying for a little while that we're about to have a big growth in the stock market, purely looking at statistics. Now, here we are, the last 3 months, very flat, very small decrease, and that's the 200 best stocks in Australia. Imagine if you went to a good wealth manager and you just picked out the top 10 or 20, you could actually, that graph could be considerably different if you just looked at the best 20. So the reason I'm putting that up is because I believe that if you're thinking of getting into the stock market, if you're sitting on the fence, now is the time, because we have been flat now for nearly 2 years on the stock market. And the history of, if you look at 100 years of the Australian stock market, when we have 1 or 2 years that are flat, we bounce up. And their bounce is usually 12 to 15%. So I'm predicting that 2024, I know there's conflicts around the world, but I think 2024 is going to see a good year on the stock market.
Speaking of bouncing back, the property sector has bounced back big time over the last 12 months, Roy, and annual changes in property values, particularly in some of the bigger capital cities, reflects that.
I wanted to, because our firm specialises in property investment, I wanted to highlight that the annual change, we're talking over 10% in 3 areas. And I just wanted to highlight Melbourne and Perth, who are the big winners over the last 12 months, but also Hobart, which has been a bit of a light loser, like values going down over the last 12 months. And if we look at the median rents, we'll actually see that Sydney's median rent is the most expensive, and that has always been the case. But Melbourne, Brisbane, Perth are right up there, Hobart being the lowest, which you would expect. And this flows on to the vacancy rate. And if you look at the vacancy rate, Melbourne, Perth, and I know Adelaide's in there as well, but the low vacancy rate, under 1% in a number of states. And here's the reason Hobart hasn't had the growth. They've got more vacancy rate than anybody else in Australia. So that just tells us there's more vacant properties in Hobart. But it's Melbourne and Perth, low vacancy rates, that has driven the prices up, which is why the annual changes are so much. So rental properties or property values have increased, which is good for property investors.
Enormous for property investors. You think about, you go back all the way to that slide that you said on annual changes. You highlighted Melbourne, Perth and Hobart, but have a think about Sydney as well. It's at 11% or 10 or 11% with a median property value of $1 million. I mean, that's a $100,000 increase in the last year alone on the median value of the house. That's an enormous return if you're lucky enough to get involved. The problem I see with this, Roy, as a young person who doesn't have a house, is that this is going to create a generational wealth divide, from people who have property versus people who don't have property. And I don't know your thoughts on this, but I'm going to guess. I'm going to guess that you're a free market person generally. But I put inheritance tax on the agenda there when I see something like that, because, you know, as I say, for someone who feels a little bit left behind in this situation without a property and without, you know, the means to get one at the moment, you know, I sort of do wonder how I'm going to get there and how my family are going to get there in the years to come. I know that, you know, I know that the solution, a lot of people say work hard, save and make sacrifice, but what do you think on the idea of an inheritance tax?
I don't love the idea of an inheritance tax, and the reason is there's one that already exists in a roundabout way, in that superannuation, if super is left to somebody who's not a dependent, then that's taxed at 15%. So that's a little bit of an inheritance tax, but the property or the investment that mum and dad own that is handed down to the children or the family, that might be how the next generation get their property. But because I agree with you, when a market like Sydney goes up $100,000 in a year, it's pretty hard to save that additional $100,000 in a year. It's not going to happen, which is why we'll talk a little bit later about the benefits of getting into property. Property, we've had what I would call a conservative year, but property has gone up over 10% in most states. It's just, that's the reason, if you can get a tax deduction, but also create wealth, that's a big tick.
RJS Wealth Management, to have all these conversations, because as you've seen, it could be the difference between, you know, really living, you know, on the line or living quite comfortably. So I think it's a really important conversation to have with a wealth manager. Did we talk about migration? I don't think we talked about migration yet.
No, we didn't. But migration is one of the reasons that we have such low vacancy rates. And this is a 30-year graph. And this just shows the history. This is net overseas migration, so people leave and people come to Australia. So this is a net figure. And look at New South Wales and Victoria. Huge numbers, historically the highest we've ever had. Arguably too high at the moment is our migration or immigration. So I thought I'd share this because this is what's driving property, more people coming. And this will be even made worse or better, I don't know how you describe it, when we have more students coming that you spoke about.
This graph is quite extraordinary. I don't think we can I don't think we can underestimate the importance of this. And Roy, you came to this idea a long time ago on migration. You've been big on it throughout the year. But let's just show that graph one more time, just to really ram home the importance of this. Like, this is a 30-year trend graph, and this is disproportionately high. And it comes at a time where housing supply is #1 government issue, because there is no solution to housing supply. So this is a very, very simple equation. We have a demand that is far exceeding supply at the moment, and there is only one way in a free market that is going to end, and that is going to end with price rises.
Yes.
Fantastic for people who are in the market, horrible for people who are trying to get into the market. So whatever the solution, and I think ideologically, you know, people are going to be on different ends of the spectrum. That's great, but it is a problem that needs a lot of attention. And I can't stress enough how much I think this issue should be front of mind, not only for governments but for everyone. We're going to have to figure this out, because when the older generation starts to get older and starts to have more of an impact on the health system, on the care economy, and on their children and their children's children, this housing thing is not going to go away. This housing thing is not going to go away, and you know, I think we're headed for and you mentioned that intergenerational report, which had a horrendous outlook for the next 40 years. To be honest, it's a huge issue.
I 100% agree, and I don't think one policy is going to fix the problem. I think it needs to be a number of policies. Certainly, I think immigration needs to be tampered down. I think that's one, because we just can't build enough homes for that. We also discourage property investors. We've spoken about this before. There's additional compliance costs, such as gas checking. If you've got solar, you've got to have it cleaned every 2 years. I have solar at home, but I don't have to have it cleaned every 2 years. But in a rental property, you do. And, you know, interest rates have gone up and costs have gone up. But in 2017, they got rid of depreciation benefits for investors. You know, bring those back. we need to encourage property investment as a vehicle to solve a housing crisis, because we can't expect the government to be spending our tax dollars on public housing.
I agree with everything you've said. I think that beyond that as well, I think your part about it not being one policy but being several policies is the most important thing. And to me, to create that meaningful change in this particular situation, this is a hearts and minds equation first. We need to figure out how we want to live. What is life after that intergenerational report? What does that look like? We need to align on that. How are we going to care for our parents? How are they going to, transition into retirement and out of the workforce? What does that look like tangibly on a day-to-day basis? Where are they living? Are they living, with their children? Are they living in care accommodation? Because none of this stuff seems figured out. And as I said to you on previous shows, Roy, this ageing economy is a phenomenon that's been around for a long time. And unfortunately, we've seen, governments from both sides over the last 15 years not spend enough time on this. So I totally agree. It's going to be a policy mix that's really important, and it requires significant buy-in from the community as well. We've all got to collectively start thinking about this, because if we don't, there will be a shortage of ideas. We'll continue doing what we're doing, and the problem will remain.
Yes, and get worse, because the housing crisis hasn't just begun, it's actually on a journey, and it's getting worse by the day.
Okay, let's take a deep breath, get into the tax tips, because that is your area of speciality, Roy. This is where you absolutely thrive, and we start with a self-managed super fund tip around property. What have you got for us today, Roy?
Well, I thought I would share this because we often get asked, can we buy a property in a self-managed super fund? And the answer is yes, but you do need about $250,000 combined with you and your partner, so husband and wife, or boyfriend and girlfriend, or whatever, and you can actually make tax-deductible contributions. And I've used the example, so assuming you're in that income band of 45 to 120, your tax rate's 34.5%. If you threw $10,000 into super, it saves you $3,450 as an additional tax refund. You can buy an investment property in your self-managed super fund, and under the rule of 72, a 7.2% return doubles in 10 years. We have just seen that in the last 12 months, property has gone up by more than 10 years, which is a great argument on why you should be in property. A 10% return doubles in 7.2 years. That's the rule of 72. Now, so the answer is yes, you can use your super fund to buy a property. If you hold that property until you are retired, so that's long-term or medium-term, depending on how old you are, when you sell that property, the capital gains tax is zero. Huge incentives to build up your property portfolio using your self-managed super fund. Don't go ahead and do it based on what you've just seen on this show. Seek some advice from a tax advisor or a wealth manager, because this is a way to create tax deductions while you create wealth.
Sorry, so just to clarify one element of this, Roy, with the self-managed super fund and the property, does that property have to be an investment property? You can't live in that property?
You can't live in it until you are actually of retirement age. Only then can you live in it. And you can't have a family member live in it either. It's got to be completely independently rented to somebody else.
Okay, so we'll cross that one off the housing crisis list as a solution.
Yes.
That's not on there at the moment. Next tax tip is claiming the motor vehicle, Roy. People know a bit about some of this, but there's some key details that you think is going under the radar.
Yeah, there's two options to claim motor vehicle. If you're a tradie or you travel for work, the first one being the 5,000 kilometres, it's a work diary. The second option is a 12-week logbook, working out what percentage of your actual costs are work-related. And what we're finding in tax audits is that you must record your kilometre reading at the 30th of June every year if you use one of those methods. And you can have a perfectly valid logbook. You put that off to a tax auditor. If you haven't stated the kilometre reading at 30th of June, they throw it out as invalid. So very, very important you record your kilometre readings at 30th of June. If you want an electronic copy of a logbook, go to our website or just send us through an email and we'll email you one back. But no charge for the electronic logbook.
Viewer question has come through around the sale of a holiday home, Roy, and this one says, I have a holiday home which I have held for many years. Do I need to pay capital gains tax when I sell?
So capital gains tax was invented in September 85. If you purchased it after that date, the answer is yes, it does apply. Keep in mind though that one property can be deemed your principal place of residence. You've used the word holiday home, so I assume you're already living in a home. You don't pay tax on your principal place of residence, but you will pay it on your holiday home, even if you haven't rented it out.
Next question that's come through from a viewer relates to fringe benefits tax. I'm an employer of electrical linesmen and I pay for accommodation when we work interstate. Do I need to pay fringe benefits tax on accommodation?
Unfortunately, yes. When people are working, even though you've sent them interstate, they have to live somewhere, you have to pay accommodation, and yes, you will pay fringe benefits tax on that. It's paid by the employer, not the worker, but depending on, as an electrical linesman, it may be that you're working in a remote area and you just need to check that out with your tax advisor online. If that is a remote area where you've got people living, you can avoid fringe benefits tax.
Yeah, I mean, I find that answer to be jarring. Like that's quite interesting. Like for for employers, who need to move staff around. Does that mean they can sort of ask you to bunk up at a friend's house because they have to pay fringe benefits tax on that?
It's a bit like this, Dave. If your employer, if SEN send you to Sydney and they say, we want you to work out of the Sydney office, and they pay for your accommodation, the taxman would be looking at it and saying, well, hang on a minute, we want some tax out of that. And if they just paid you wages and you paid accommodation, it's not a tax deduction. So if you negotiate with your employer for them to pay accommodation direct, fringe benefits tax applies. It's just logical when you think it through in that way.
There you go. No, it is logical, I guess, when you do think about it that way. And a segment where you've made a lot of logical points that government should listen to is Roy's Rage for the final time in 2023. Roy, where are you going with this one?
Well, we know that there's two methods to claim home office costs while you work at home. And this has been really big since COVID. On the left-hand side, there's 67 cents per hour, and that rate includes internet, mobile phone, electricity, stationery, etc. Bear in mind that last year, that rate was 80 cents per hour, and we could claim all those items separately. So they've factored that in and dropped the rate. So they're trying to reduce the refunds. But on the right-hand side, there's an actual cost method where you can claim the actual costs and you get to claim electricity and gas. This is my rage. I am annoyed that the calculation formula for electricity and gas is horrendous. This is a little worksheet. You actually have to work out the cost per unit for your power based on your recent bills. So let's say, in this example, it's 0.42. You've then got to go to the website to find out how much the type of computer you have, it costs average units per hour. You've got a laptop, you've got lighting on your desk, you've got lights in the office that you work at, an air conditioner and a heater, and you've got to work out by the internet on what it costs per unit to run. This needs a degree to work this out. The public don't know this. Tax office investigators or auditors can't even cope with this. It's a horrible formula. Get rid of it, scrap it completely. Just give us a set rate that relates specifically to gas and electricity that says that's the rate you can use. Pick it out. Don't care if it's 5 cents or 10 cents, whatever it might be, but drop the formula. That's ridiculous.
Can we see that again? Can we see that again, that graph? Because, Roy, so this person has claimed total annual hours of 963 for each item.
As per his work diary, he's worked 963 hours in the office.
They've had the aircon and the heater on at the same time.
That's what it looks like, yeah.
What's going on there?
No, that
Which one is it? Are you hot or are you cold?
So what he needs to do there is say, well, for 6 months, I'll probably do half 963 with the aircon. But what about the hours when you didn't have either on because it's quite comfortable at home? This is no good. This is not a good way to work out home office. You've got to dump it. The tax office have to see the logic on how difficult this is and just get rid of it. Just give us a set rate.
Before we go, we always like to give a shout out to a transcendent business, a great business, a business that does more than what the community expectation is. What business are we giving a shout out to today?
We're going to give a shout out to R J Sanderson Associates, accountants, advisors, wealth managers, brokers, we have our 30-year anniversary, and I just wanted to say thank you to all the RJS team. A big shout out to us. We're very dedicated. We've got about 125 people across 14 locations, and that's our mission statement. We get along very well, and I thought it'd be great just to highlight RJS, very dedicated, very good at what we do. And I thought I'd share with you our core values, because our number one core value is family. So we know that in our lives, Dave, your family are the most important thing to you. In my life, my family is the most important. So these are our values. This is what makes our organisation so committed and so good at what we do. And our byline, our throwaway line is, we only employ great humans at RJS.
Congratulations, Roy. 30 years, that's a phenomenal achievement. So I think, full credit to the team and a big thanks from me personally for the job that R J Sanderson and Associates has done for me and has played a role in this show. Speaking of which, this is the last episode for this year. We don't know whether we're going around next year, but I just want to give you a bit of a recap of the year on a serious note before we finish. It's been a year that has been headlined by high inflation and a serious surge in interest rates. It's been a year that has been very tough for people out there with mortgages. People in the community are doing it tough at the moment, and things are sitting precariously across the board. It started with a crisis in Ukraine, and it's going to conclude with a crisis in Israel at the moment. We've seen supply shortages, we've seen low unemployment, we've seen, as we said, high inflation, high interest rates, and miserably low consumer confidence. Roy, if this is the last episode, give us your thoughts on what is going to happen next year and whether there's anything we can hang our hat on in terms of the outlook for the future.
I think property will continue to bubble along. I don't think it'll do 12% or 10 to 12%. I think it'll be 7 to 8, back to around average. I think there's going to be pressure on house prices to go up simply because of the factors we just spoke about, low vacancy rates and high immigration. I think the stock market's going to have a good year despite some international crises. And I think that'll be a great year for the stock market. And I think if you're on the fence, get some advice. I generally believe that. I think inflation will come under control slowly. I'm hoping for no more interest rate rises because I just don't think the public can accept it. I think there's too much pain out there that will show up, and mental health becomes such a big issue that we are talking to clients quite regularly about because of the financial situations they're in. I hope that listeners have got a lot out of the show this year. And if you think we should continue it for next year, send through an email. We'll look at the votes. We think it's different. It's unique. It's something that no other accounting firm or advisory firm are doing. We try to cover off all the topics, not just the share market and property, but the economy and the statistics, the stuff that you don't see every day, and we bring to you once a month. So if you think it's worth continuing, send us through an email.
This is season 4, and in Australia, commissions that go past season 3 are all privately funded. So you don't see many shows that get into season 4. We've done well. We've had a lot of fun, Roy. Thank you. Thank you for the opportunity on R J Sanderson TV, and thank you for all your input over the last 4 years that saw us start in the middle of a pandemic when we really couldn't take these messages to people in person. And it's potentially finishing here today, as I said, with things precariously poised. Let's hope it's not. Let's hope we're back next year. But if it isn't, thank you for everything all the opportunities you've provided SEN and myself personally on RJ Sanderson TV. And thank you for your contributions.
Thanks, Dave. And what everybody says at RJS is Dave Kennedy is a gun. So all down to you.
I couldn't do it without you or the team out the back. A big shout out to the team out the back who do a fantastic job producing this show every month. This has been RJ Sanderson TV for October, the final one for the year. Thanks so much for watching.